All right, so we're moving towards the end of April. Today around 9:25 Central, something that was important. I went from saying be careful long to wait a second. Not as much weakness in the ES as we've seen in the NASDAQ. I'm going to play both these charts. On the right's the NASDAQ. On the left, it's a footprint of the ES, okay? Playing this 5 times the speed. What we noticed is the NASDAQ had a consolidation box that was forming right here, okay? Through the middle of it, it gets a little bearish, right? So let's watch it. Gets a little bearish, does something that's interesting. It breaks from 48 to 42, but then starts coming back up. Watch the ES at the same time. It does it. This is right around the bottom of the hour, Central Time, 9:30. It creeps up through 48. We talked about it should have more upside, just didn't have it. And a lot of times what the market has to do is what a market has to do is shake out too many longs. Too many longs, too many sellers, tough to go up, okay? So as the NASDAQ slides back south, it goes a good 6 or 7 points, and the ES barely could break, which shows a nice divergence between maybe some underlying strength in this guy. We're still waiting for this to happen. Now, the call wasn't, hey, we're going to go down to 42. The call is after we go down to 42 and start creeping up, and after we go down to 42 and you don't see as much of a break in the ES is when you start scratching your head. And if you're bullish, you start getting ready to qualify along because this could have a head fake pattern to it. There's the drop right there in the NASDAQ. You see that quick drop? I paused it. You see this quick drop to about 42, 43, and the ES breaks, but barely. Soon as you start to creep back through the middle of this consolidation, the upside's the right side. And that's the call. That's not hindsight. That's knowing that the middle of consolidation, the middle of all this congestion is important because you start moving through the middle of it. What you did is clear out weak longs. Less longs equal less sellers. Let me write that out in an equation. If you have LL, less longs, that equals less sellers. Just think what happens when you cover a long position. You're no longer a seller. So if there indeed is less sellers in the market's price has a better chance of going up. It's not 100%, it's a probability. And that's what we try to do as traders is stack probabilities. That's how you sharpen your predictive skills, stack probabilities that make sense though. And this has to make good sense as to why price moves. Too many longs, too many sellers can't go up. Shake out, and I often call it the head fake or the other side of the valley. So let me also show, by replaying it, another thing we said in the room was once it gets back up to around 48, there's the drive to 40. Once it gets back up to about 46, 48, and the NASDAQ, that's on the right side of the screen, it begins to look like the other side of the valley. And what was said is there's less longs here than there, and I'm going to illustrate that in a second when it jumps. The ES did not cooperate, meaning it didn't go down at the same rate that it should have with a big break like that. So there's the jump back. Let me pause it. Once it gets back in here, there's less longs potentially at that X than there was at the same price, but at that X. What's the difference between the two X's? That valley, which did what? Shake out longs and create the LL, less long scenario. And it also does another thing, and this is what's important. Less longs equals less sellers, right? But it also creates more shorts, and more shorts create more buyers. I don't know about you, but if I'm short, I'm a buyer. So more shorts because of the move lower. You remember a slide that I've done many times in webinars. It's got like, if you think like a fifth grader and do the opposite, you'll be in good shape. When a market goes down, all the fifth graders say, let's get short, let's get short. So they get stuck short as the market goes back up, and if it goes through them, they're stuck and become more buyers. Less sellers and more buyers. That's the dynamic that has to be in play for the price of anything to go up. You don't have to be a rocket scientist to know that. In fact, I don't want you to be a rocket scientist. Rocket scientists stink at trading because they have trouble admitting when they're wrong. What's in trouble in this valley is the top of the previous congestion. Again, all this stuff is in hindsight. We do this in the room daily. When we're wrong, when I'm wrong, I'm not wrong for long, and that's what's important about trading consistently, is be wrong, but not for long. You guys want to notify these videos that I post daily during the week. I think if you hit that bell, you'll get notified, but you got to subscribe first.